Great. Thanks, Haley, and thanks everybody for joining us. So today we'll take a look forward in what we expect for the coming year in terms of the cloud market. I have two senior analysts, Evan and Catie, joining me. And so I'll start with a high-level view of the overall market in terms of what we're seeing both from the vendor side and hearing from customers about their plans for the coming year in terms of investments in cloud solutions. And then Catie will look at a little bit more deeper view in terms of the infrastructure and platform space and some of the changes in the business strategy we expect to see in that area. And then Evan will take us through in the application and SaaS space some of the approaches to the headwinds that are facing some of these vendors in the coming year, how they're going to combat some of that with their portfolios as well as go-to-market approaches. So starting with the overall view, in some ways it's a return to basics for what we expect both from cost, and that's really in the context of both what vendors are already started to do in terms of paring back some of their operations, looking at reducing costs not only with the headcount reductions, but looking at their own operations from a delivery perspective to adjust to an environment where there's not that steady growth that they've really grown accustomed to over the past 10 years. And then on the customer side, similar focus where instead of focusing on transformation at all costs, really investing into cloud initiatives as much as they could to get the growth and expansion benefits from those solutions. Customers taking a more measured approach in terms of some of these decisions and really going back to financial backing, which if we go to kind of the start of the cloud solution area in the 2007, 2008 timeframe, within the context of that recession, really looking at cloud as a way to reduce IT expenditures, to delay IT expenditures. In some ways, the market has gotten away from that for a lot of customers, where they focused on the innovation and value benefits of cloud solutions. Cost was probably always an underlying factor. But in an environment where there is, threat of a recession, impact on valuations in the market, rising inflation, all those things are kind of combining to change the behavior going into the year. Even though it's not officially a recession, it's top of mind for really all businesses in today's market. And so it's changing the decision making. At the bottom, we have just kind of a, something that echoes a lot of what we've been going through. Salesforce being the largest applications provider, I think in some of Evan's coverage, that was a recent shift where not only have they been the largest cloud application provider, they've become the largest provider of all delivery methods just recently, and so very, very exposed and prone to shifts in spending. And the seat-based models, subscriptions that have driven a lot of that growth on the way up as the economy has expanded and headcount has grown, and licenses have been added for Salesforce and other SaaS applications. They're seeing some of the downside of that, or expecting to see some of the downside in some ways as headcount growth slows, as the labor market, which overall continues to be strong. But if you kind of dig a little bit below that, within the functions and verticals where applications like Salesforce are really driven by the employment numbers, not as much growth, flat to down in some ways for those professional roles, where it's really driven a lot of that expansion over the past 10 years. so it's plateauing a bit. And the situation for a lot of vendors is they're not going to necessarily reduce expenses. They're just going to stop investing so ahead of some of the expected growth in revenue, because they're looking ahead, revenue slowing already. It's an annuity base, so it's not an immediate effect, but they know that slower new business development today is going to translate into slowing revenue growth over the next coming months and years, and so they're reducing a bit to align their resources with the expected reality of the market. And so what does this mean? So from a vendor perspective, messages that tie back to the cost savings, the financial benefit, the business case for a lot of these solutions is going to be a bigger driver of deals in the coming year than it has been, where it's just more of a focus on expansion and agility and innovation. All those things are great, but a business case and a financial case to support some of those decisions is going to be more important going forward. That takes time. That increases the scrutiny and sign-offs and timeline for a lot of deals. And so you're going to continue to see investment from the customer side. It'll be at a slower pace, and vendors have already started to make changes and decisions that will align their business to that reality that is pretty certain to play out in terms of the coming year on the demand side. So that kind of sets up what we're expecting and already starting to hear in terms of the cloud market in the coming year. We wanted to put out a polling question, get your feedback for what you're seeing and expecting in 2023, and the impact on your deals, whether it's in the cloud platform space, software. It's all tied together in an ecosystem in a lot of ways. So I'll continue on with the presentation, but let us know your feedback around what you expect in terms of cloud investment and spending for the coming year, and then we'll share those results before we move on to the next section. Okay, so going down a layer in terms of within these spaces, what do we expect from different vendors and kind of segments of the market? So the larger vendors, so if you look at it on the platform side, the AWS's, Azure, to a lesser degree Google, have benefited in a lot of ways from the scale and reach of their portfolios and presence in the market during that expansion period leading up to 2022. That's kind of sustained their growth for longer than we've expected. We've, over that time period, adjusted a lot of their growth rates up over time. You expect to see eventually some slowdown due to the law of large numbers, but they've been pretty resilient. However, for a lot of those larger vendors, and you see it in Salesforce and AWS and Microsoft already, that broad base of cloud revenue and presence makes them more prone to some of those slowdowns in investment, rationalization as Salesforce's change in terms of licensing and subscriptions. So they're going to be a lot more challenged for growth. Bigger portion of the market, more exposed to the overall change in trends in spending. But on the upside, we do see continued growth opportunities for some of the smaller vendors that fill niches in the overall market, and that tie back to key initiatives around things like cloud management, cloud security, data management, analytics. All of those markets we think are really ripe for some of those smaller vendors to continue growing and outpace the larger vendors and outpace the market rate of growth, because even though there's still some discretionary investments going on, with cloud, those things may be slowed down. A lot of it is just essentials and critical things that address either justify themselves with clear cost savings in a lot of ways, or address some of the risk and the financial implications of that risk for customers that have adopted quite a bit, shifted a lot of their environment over to cloud delivery over the past multiple years, and now really need solutions that help to optimize, secure, and manage those environments. Those tend to be less prone to the whims or the economic environment in terms of their justification. And so we think for a lot of those smaller vendors playing in those spaces, they'll continue to grow and outpace independent of what happens from an economic perspective in a lot of ways. And then lastly, when we look at kind of the go-to-market strategy, the manner in which some of this growth is going to occur, we think partners have been playing a bigger role really over the past couple of years, but that's only going to become more important with some of the trends going into 2023, where from a customer side, being able to, again, go back to the risk for some of these initiatives, have a partner that's going to, from a services perspective, help design, advise, implement, manage. All those things continue to be critical for customers and challenging in today's labor market to maintain from an internal skills perspective. So there's going to continue to be a robust demand for services around cloud environments, really up and down the life cycle. And then also, getting to some of those more industry specific and solution tailored outcomes that are more of what we're seeing in terms of cloud investment over the past year or two, as well as going forward, than has been to date. So it's less about the functional horizontal capabilities of these solutions in a lot of respects. The industry customization a lot of times comes from a variety of vendors, many of them smaller and more niche and focused. And so being able to harness that and leverage it as part of the overall ecosystem strategy that the larger vendors have been developing, ties in both from partner-driven growth as well as supporting that kind of narrative around how smaller vendors and more focused players have a better opportunity to weather the economic uncertainty and challenges going into the year than some of those larger vendors. And so I think it's, as you see some of the direct sales forces pare back for some of the cloud vendors, again, just reinforces the value proposition for an ecosystem that can help sustain the go-to-market, add value, and really kind of meet what customers expect from an outcome perspective now with these cloud solutions. Really highlight that and make it more important for the coming year in terms of the growth that we still expect to see, albeit as a slightly slower rate than we expected, a year ago or have seen over the past 5 years. Okay, so before we go over to Catie to deep dive into the infrastructure space, here's the feedback directly from the audience here in terms of what you expect to see. So the second option, the longer sales cycles but sustained growth, I think if you net everything out for what we expect, that's pretty much in line, that there may be delayed spending, but the value is there. It just needs to be positioned in a way that resonates and go through a longer sales cycle in order to actually be implemented and approved. And then that growth is going to be balanced by the reduction. So that was the other big category of responses that in a lot of areas, and We're already seeing it in some of the SaaS subscription reporting out of the big providers there, that they are seeing a reduction as customers, adjust their own businesses as well as look more closely at controlling costs and heading into 2023. Great. Okay, all right. With that, I'll hand it over to Catie to take us into the infrastructure side.
Great. Thank you, Allan, and thank you, everyone, for taking the time to join us today. So moving on to our next big theme and going through the prediction that we put together for our cloud infrastructure and platforms research stream. And one of the big trends that we're monitoring, we continue to monitor, and we really expect to see take shape through 2023 is around the steps that the hyperscalers will take to monetize PaaS and really continue to race to commoditize the control plane layer. And, because of that, there will continue to be this degree of overlap between the hyperscalers and their partners, some of those pure play platform specialists that we call out on this next slide and that we're tracking throughout our benchmark. Now, the partnerships between the hyperscalers and platform vendors are obviously highly critical. The hyperscalers need to meet customers where they are, and these platform specialists need to tap into that infrastructure customer base. And that dynamic won't really change, but you do see the hyperscalers, the large infrastructure as a service vendors, continuing to build up the stack. And so we'll continue to see this overlap and what we call co-opetition, which is really nothing new in the cloud industry. We talk about that concept quite a bit, but we do expect it to ramp up because of these dynamics. And when we take a step back and kind of look at the driver of this, it's really based on how saturated the infrastructure as a service market has become from these hosting providers themselves. The on-prem infrastructure as a service vendors are a bit of a different story, but it's really the hyperscalers that are leveraging the sheer scale of their infrastructure to expand in all these new areas. And AWS is a really easy example of this. At their annual reInvent conference, we listened to all of that content. It was really a story about serving customers across the data pipeline, from ingestion to analytics up to governance. And so they launched a bunch of new capabilities in this area. And they also launched a SaaS application, a supply chain service, not really directly comparable to the likes of Oracle or SAP as how we would look at it, but it's still a really strong indicator that they continue to move beyond general purpose compute into these other areas. And it's not just AWS also, it's really the other hyperscalers as well. Google Cloud, while very partner friendly, really trying to position as kind of the go-to for customers looking to build their own data clouds. Now, obviously, these platform-centric companies you see up here have a huge niche in the market. They're really addressing customers who want a customizable, more feature-rich platform that perhaps most importantly helps them avoid vendor lock-in and move the data freely between where it needs to go. And we know that is a top priority for customers. So there's tremendous value there. And, with the customers that we interview as well, these third-party solutions, if you will, are being used because some customers still don't really believe that their hyperscalers' native capabilities necessarily go far enough in terms of features and functionality. They're telling us, they might reevaluate their hyperscalers, some of their services in a couple years. But right now, they're really not there or where they'd like them to be. And so that's where a lot of these tier 2 players kind of win. Now, that said, when we look into the future, again, AWS has a really great track record of kind of releasing really basic capabilities to the market, but quickly building them out into these competitive services over time. SageMaker is a great example of that. And so that's one instance where, AWS is taking steps to kind of help customers consolidate point solutions. And it could prove threatening to some of their partners and some of these other players down the road. And as far as predicting, for 2023 as well, acquisitions are a big consideration. The hyperscalers have been acquiring last year. The Google Mandiant acquisition comes to mind to really strengthen Google's hold in multi-cloud security. So a hyperscaler picking up one of these bigger tier 2 players to get a stronger foothold in a specific layer of the data stack, that's definitely a possibility as well. And then the last thing I'll just mention on this slide, this graph is from our semi-annual cloud infrastructure and platforms benchmark. So we're mapping PaaS-only revenue and growth across the landscape. This is data for 2Q22 and 4Q22 will be out shortly. But I also want to mention we're launching a cloud data services market landscape this quarter, which is more qualitative. It takes a deeper dive into a lot of the vendors that you see here, but some others that aren't on this list, like Databricks and Confluent. And so in this report, we'll really go beyond high-level PaaS and break down the data stacks, some of the trends in like data warehousing and analytics and so on. And then another big piece of that will be the go-to-market trends and some of the specific areas where the hyperscalers work with these guys, but also kind of compete with them in some degree. And so taking this prediction theme that we're running with a little bit further. So if that's a topic of interest, would definitely recommend, and that inaugural report is scheduled for March of this year. So this whole topic of the hyperscalers' pursuit of PaaS really segues into this next big theme we're seeing, and that's around vendor consolidation. So best of breed SaaS is still very much alive, and you can see that in the bottom graph here. Customers generally are going to increase their number of applications vendors, but at the platform and infrastructure layer, they mostly indicated that they want to stay the same. And as we continue to survey buyers throughout 2023, we may even see some decreases. In general, in our latest round of discussions, we heard customers a little bit more this time that they are trying to consolidate workloads with a single provider. And there's been quite a few scenarios where, like, a large enterprise perhaps acquires a company that is on one cloud and they want to rehost and refactor to their cloud. Because of cost and time, maybe that's not a project that customers are willing to take on this year, but I think it's definitely those kind of scenarios are part of the longer term roadmaps, and that's just one example. And again, customers may have like 90% of their workloads in one cloud and a smaller portion with another, and they kind of have to weigh from a cost perspective, if it's beneficial to re-architect and consolidate with their main provider. And on this chart as well, over 1/3 of respondents say that they are just using one infrastructure provider. So I think we are seeing customers in general try to take steps toward consolidation, and kind of these macro pressures that Allan mentioned are playing a big role in these decisions, really from a skills and training perspective, and then of course cost, that makes multi-cloud maybe still ideal for customers from a diversification perspective, but not necessarily feasible for a lot of businesses right now. And of course, it's not a black and white issue. The need for hybrid or multi-cloud is extremely dependent on a customer's industry and, their business and what their existing IT estate looks like. But in general, we have heard many customers tell us that, hybrid cloud in particular is not necessarily a destination, but it's really just an approach for eventually landing with a sole public cloud provider. So customers appear to be realizing that, and we've heard it often through the latter part of 2022, and I think we'll continue to do so through 2023. And that's really from the customer side, and from the vendor side. Obviously, they took some hits this year. They weren't immune, but the opportunity for cloud migrations yet to come is clearly still huge. And so to Allan's previous point, again, both the big hyperscalers and their partners, some of the pure play PaaS vendors, if you will continue to benefit from this. So Evan, with that, I'm going to hand it off to you to go through our applications prediction.
Thanks, Catie, and hello to everybody on the line, and thank you for joining the Cloud Team's first webinar of 2023. Final prediction we will review today pertains to the SaaS market. The headline of the webinar was Cloud Vendors Will Use Predictable Strategies for Unprecedented Times in 2023, which frankly perfectly tees up how we feel SaaS vendors will weather the economic challenges heading through the year. Specifically, in 2023, SaaS vendors will aggressively pursue solution up and cross-sell to expand client ARPU and then weather the economic pressures. Albeit far from a shocking prediction, to sustain performance amidst challenging times, sometimes it is better to keep it simple and rely more heavily on portfolio tactics, which these companies have been long employing. It will come as no surprise to all of you on the call that while SaaS entities stood to benefit in large part from the pandemic challenges, which necessitated a global shift to remote operations, these same entities were far from sheltered from the macroeconomic challenges through 2022. Cloud vendors and their ICT counterparts continually revised revenue projections through 2022, driven largely by unfavorable FX dynamics. Likewise, profitability suffered, particularly for the IaaS behemoths, as external factors like energy costs and labor market competition rose. Throughout 2022, SaaS vendor commentary and earnings increasingly highlighted how these challenges were not just impacting them, but also their global customer base. Commentary by both Salesforce and Workday in 3Q22 in particular spoke of prolonged deal cycles as a result of additional layers of executive approval during the procurement process. A finding which led Workday to highlight how critical it was during the quarter to bring clear business cases to prospective clients to prove the value of a project with tangible ROI indicators and confidence in the TCO. In the early days of cloud, proving the cost savings of migrating from legacy software to cloud was a key decision-making criteria for organizations. Cost, of course, has always been important, but was much less crucial, especially during the pandemic when the organizations were forced to embrace cloud to maintain business continuity. In 2023, though, cost will again be top of mind for global organizations. Outside of clients' more scrutinous decision-making, we also saw evidence of user seat growth moderation from companies like Microsoft, who attributed it to a moderation in new deals through the year. While this user seat moderation for SaaS companies will be influenced by the sheer scale of their installed base for some of their core SaaS workloads, if the economic environment worsens and global hiring and layoff measures are enacted, it will exacerbate the issue for vendors. While the economic challenges are many, it is the confluence of these forces which is driving down growth for SaaS incumbents. For example, Salesforce's SaaS growth waned through 2022, particularly for the core cloud suites which comprise Customer 360, Sales, Service, Marketing, and Commerce Cloud. Combined, these Customer 360 assets grew revenue just 11.9% in 3Q22 on a year-to-year basis compared to just over 20% in the year-ago quarter. Of course, this slowdown is partly attributed to FX, but also a result of more challenging sales environments. Salesforce is obviously not alone in this slowdown, with similar findings across the SaaS market. The company's approach and how they sustain growth in 2023 will also be enacted by SaaS entities across the board through the year. First, expanding share of wallet from the existing install base will be crucial for SaaS vendors, particularly if user seat growth further moderates or declines through the year. To establish cross-sell opportunities, vendors will increasingly seek ways to bundle complementary offerings to address a greater degree of client needs. To highlight this approach, let's consider it in the context of Salesforce. Salesforce's strategy has been dubbed the Digital HQ, which was launched immediately following the company's acquisition of Slack. Upon close, multiple Slack-first extensions were developed across core Customer 360 offerings like Sales and Marketing Cloud. In short, with Slack, Salesforce would be not just an enterprise's front office provider, to communicate with customers and engage them across the customer journey, but also provide the internal communication and collaboration mechanism via Slack to empower and enable internal staff in their day-to-day operations. While the addition of Slack opens cross-sell opportunities within the Customer 360 install base for Slack, it also creates the same sales opportunities for C360 within Slack. More crucially, by proving the value of leveraging Slack alongside a suite like Sales and Marketing Cloud, it creates additional cross-sell opportunities for Salesforce to sign up users of one C360 module like Sales Cloud to additional modules like Marketing Cloud, or as Salesforce more simply puts it, create a digital HQ. To further expand client wallet share outside of cross-selling, vendors will also layer value-add solutions around core SaaS products. Again, using Salesforce as the example, the company has increasingly expanded its toolkit of PaaS offerings over the last year in areas like low-code, no-code, RPA, BI with Tableau, and AI with Genie. Likewise, investments around pre-built data models has been the initial thrust by Salesforce as it builds a growing array of industry clouds containing connections to industry data consortiums like EHR in the context of healthcare. To incentivize the adoption of these emerging portfolios and capabilities, Salesforce has continually built them as natural extensions from its flagship Customer 360 products to incentivize the upsell. Highlighting this approach was the rebranding of Sales Cloud Unlimited in 2Q22, which added various data products, industry modules, and so forth to give clients access to its newer offerings if they upgrade their pricing tier to Unlimited. The examples of upsell initiatives by SaaS entities are many, be it Microsoft's addition of Nuance, NLP, and AI alongside suites like Dynamics to automate the transcription of calls directly into a CRM, and then have an AI recommend follow-ups to a sales personnel, or also more simply SAP's work around Signavio and other BPI offerings as part of S4HANA. All told, these efforts create opportunity to broaden ARPU and mitigate risk if new user growth further moderates. What it also does is increase competition with smaller SaaS players whom they compete with across various workloads across the front and back office. In our latest cloud and software applications customer research, which is set to publish next week, feedback from clients increasingly cited the need to consolidate their vendor landscape and rationalize licenses for products which may be either unessential or capable of being addressed by another vendor that they already work with and hold licenses to. If economic headwinds worsen through 2023 and the need to further control costs rises, clients will increasingly be combing through their licensing, either themselves or with the help of a third-party services partner, to understand what licenses they hold across lines of business and which vendors they work with that provide overlapping capabilities with a vendor that they also hold licenses with. From there, organizations can determine ways to consolidate around a provider. And while yes, fear of vendor lock-in may make this a hard decision to make, for smaller organizations in particular, this will improve their buying power and potentially allow them to obtain discounts across IaaS, SaaS, or PaaS to reduce their overall IT spend. This in particular could benefit SaaS incumbents increasingly pursuing solution bundling and layering, and thus heighten competition with the smaller SaaS peers. Think back to the points earlier on why clients will be layering and bundling. The niche players who offer one specific workload serving the outcomes of potentially just one line of business are going to be incredibly pressured. To be fair, the opportunity will remain strong for ISVs who serve niche client needs, such as industry-tailored solutions for sales, as incumbents will continue to leverage them as part of their ISV community to strengthen the value and increase their IP stickiness in the enterprise's environment. And findings from our research indicate the number of SaaS vendors organizations work with is set to grow over the next 3 years, as Catie showed earlier. But this largely will be additions of vendors serving highly specific needs or outcomes, not horizontal functions. For smaller firms, though, serving these horizontal workloads, like a CRM, for instance, the pressure may rise, particularly if their value proposition revolves around leveraging partners to enable more complex outcomes to a client, partners who undoubtedly work also with the SaaS incumbents their clients are working heavily with too. These players can't do the same discounting on their core products that a SaaS provider views as a tentacle into a group for accelerating the proliferation of their IP. If players continue to discount, bundle, incentivize upsell to higher cost packages, which allow them to use the additional features that are contained within them, it will only increase the challenges that these smaller firms face in an already challenging macro environment. And with that, I'll flip it back to Allan to wrap and open up the Q&A.
All right. Sounds good. Yeah, so that's what we expect going into 2023. I think the economic environment, the overall slowdown in cloud growth is the clearest expectation going into the year. And then obviously different strategies and adjustments on behalf of the vendors that we expect to see across the infrastructure, platform, and software as a service landscapes. And those will be evolved along the way as some of this uncertainty lifts and we actually get to understand what the economic reality is. In some ways, as we saw with COVID, the uncertainty is really the biggest challenge. It's not a clear picture of the market and how customers are going to respond. And I think that's where we're at today in terms of both customer and vendor behavior, where they're apprehensive, they're pulling back a bit, but the reality of the economy has not become clear or evident just as of yet. All right, so during today's discussion, we had a couple different questions come in. So I'll start to read through some of those. Please feel free to continue submitting questions through the chat box on the application, and we'll handle as many as we can live today, and then follow up with any others that come in afterwards. All right, so first there was a question around hybrid cloud. I think it was during some of Evan's slides. It says, you're thinking about hybrid cloud adoption is transitory before customers adopt only cloud, ? Is there no longer a future for hybrid cloud? So looking for more clarity around how we expect to see the hybrid deployment model kind of play out going forward and long term. Catie, do you want to take the first cut at that one, and then Evan, you can join in?
Yeah, sure. So that's a great question, and I think definitely worth clarifying. I think what we're hearing mostly from hybrid is customers really view the integrated on-prem stacks offered by the hyperscalers. Those are more viewed as the stepping stone to public cloud. So, many customers will deploy like Azure Stack or AWS Outposts with the end goal of having all those workloads hosted in a multi-tenant Azure or AWS environment. So I think that's one of the big use cases for those integrated hybrid solutions. And I think this year or this past year, we've heard less about hybrid just because of the broader macro trends we've been talking about. But hybrid, I think long-term definitely is here to stay. I think we're also hearing, because the reality is, some applications aren't suited for public cloud for a whole host of reasons, mostly latency, security, and governance. And, despite the steps I think the hyperscalers are taking to address that, customers still are keeping those workloads on premise, and they're not going to move what they don't feel that they have to move. So there's definitely use long term. And so I think we'll continue to see that. And then also a smaller degree of customers repatriating workloads back on premise because of the cost, mostly issues that they've experienced with their public cloud providers. I think that happens less often, but I think we have heard a couple instances where workloads are moving back on-prem. So hopefully that provides a little bit more clarity, and team, feel free to add anything.
Yeah, just one thing to add, and something we found in the customer research that we just did actually, is the way that the person we were speaking with kind of put it is that he views hybrid IT as more of this transitory phase, like it's a stopgap where it's not going to remain forever. These clients are looking for ways to, over time become more in the cloud for various workloads and functions, and start to rationalize away those data center assets they have as they reach end of life. But in terms of hybrid cloud, I think, and this again also came from the customer research, we saw a slight uptick in the number of respondents who select private cloud deployments, and it's a small downtick in public cloud. But what we kind of attributed that to is, we're seeing more, regulated or data intensive workloads or mission critical workloads, like payroll, finance, things in ERP, start to make that migration. And though customer trust in public cloud is rising, it's just not where the public cloud or private cloud is today. And so some of those workloads might be making their way into a private cloud instance versus public. And so I think hybrid cloud will remain, but over time we'll see less and less in terms of hybrid IT. But as Catie mentioned, it won't go away forever, so to speak.
Mm-hmm. Yeah, and I think for a lot of even the more advanced customers that we speak with today, very few are 100% cloud. A lot of the legacy environments and applications that still work today still run on a lot of times proprietary hardware, mainframe type environments. There's not the business case to move and migrate those, at least in terms of the foreseeable future. But over time, eventually they will face some type of decision point that they're either modernized, replaced, or different decisions are made. But also we continue to see continued traditional deployment and license activity for various reasons, with today's decisions. So never fully going away. Very few customers, I think, will get to 100% cloud, but you just start to get those exceptions being a smaller part of the pie over time. Let's see, a question around the shortage of skilled labor. How big of a factor do we think that'll be in cloud adoption in 2023? I can start in just a little bit, and then maybe Evan also covers a lot of the professional services firms where the attrition and hiring has been really pronounced over the past couple of years, so we can maybe he can jump in as well. But from an overall skills perspective, with some of the layoffs you've seen with some of the bigger cloud providers, obviously that changes the labor dynamic a bit. However, I think it's still majority. There's a shortage of IT skills, and a lot of times it's those vendor jobs are very attractive for top talent and volume of certified professionals, that type of thing. And customer IT departments are more challenged to hire and maintain and compensate at competitive levels there. So I think it's going to be a little bit of an easing. I think on the whole, though, there's still not enough trained, certified cloud IT security professionals out there to satisfy the demand and kind of have that balance. So I think it eases a bit, but still a challenging skills environment for even enterprise customers to get everything they need from an internal IT team perspective.
Yeah, I think that the labor question just speaks to the necessity of these, the hyperscalers in particular, Microsoft, AWS, and Google, maintaining these vast ecosystems of IT services and consulting partners. It's no secret all the large SIs at this point have dedicated business groups for the cloud providers. It's not just Microsoft and Google. There's also the SAP, Workday, Salesforce practices that they have too. And we're seeing a lot more, I would call it just training between the partners. So I think Microsoft with Kyndryl and EY, and a couple of announcements they had in the past 6 months or so. It was like, I think EY is bringing like 30,000 or 50,000 Microsoft, technicians, they call it. But then there's plans to train another, I want to say it's like 100,000 over 5 years or something along that magnitude. But I could be wrong. Don't have the numbers up in front of me. And then there's something similar with Kyndryl as well. And so it's silly to think that these cloud providers are going to be able to maintain the necessary skills on hand to be able to deal with all these customers that they serve, especially as they start to pursue growth in all these different industries with these industry clouds that they're launching. They just don't understand the processes, which half the battle in making a solution like that work is being able to, speak about that solution in the context of the operations of that client. And you need to have people from the industry to be able to do that. From a client perspective, the labor shortage, which is going to bleed into another question that we have here on application migration and how that will be addressed going forward. We've seen a lot of investment around low code, no code, these citizen developer-esque tools, we'll call it, where the organizations that lines of business can kind of do their own integrations, create their own rules engines, drag and drop, so on and so forth, so that it kind of removes the choke point of IT to deal with these one-off little requests. But I think what that all speaks to is that in order for that to work, there needs to be larger libraries, so to speak, of configurable outcomes around these applications, so that it's less customization and more just a small tweak, so that it's not. Because without that, if you require the custom coding, that maybe you have to go work with a third-party services provider to do so, the TCO of the initiative is going to skyrocket, and especially in 2023, that's not going to be making clients feel warm and fuzzy. But if you can put enough, configurability into these solutions, be it through a CRM for manufacturing and so on, then you're going to be able to kind of remove some of those bottlenecks and then also be able to scale the offering within that sector. But we just don't see it today. I mean, all the feedback we received in our latest customer research was that these industry clouds are marketing hyperbole with limited solutions or functionality within them, because really the bulk of them are just those pre-built data models, and the approach that these vendors are trying to take is they use these data connections and integrations to kind of draw in the ISV partners to start to do the industry tailored outcomes across the spectrum, but it's been slow moving.
Okay, great. Yeah, so just to the question around the impact on application migration, Evan hit on it from his perspective. Just to add a little bit to it, for a lot of the bigger activity around SAP, Oracle, those types of environments, those are long-term projects, a year or 2 years. So for things in the work, they're going to work through that and get them done. There won't be as much of an impact there. We're looking for things that are signed, announced today in 2023 that'll have financial impacts over the next couple of years. I think that's where you start to see more of those slowdowns, change in perspective and focus on cost and different value propositions for those initiatives. So I think it does have, in some ways, a slowing effect, but it'll take longer to represent itself in terms of the market opportunity than some of the other solution sets. Let's see. All right. So one more question could be the final question. Looking at the cost of cloud for large-scale deployments, it being a big factor, do we agree that for large-scale infrastructure as a service, deployment of the cloud, the economics of cloud are questionable? Yeah, I think that's being looked at more thoroughly today, where actually for a lot of the customers we've spoken to over the past couple quarters and years, before, say a year ago, before a lot of things really started to change in terms of inflation and the economic uncertainty, where there was an acknowledgement that, especially for larger deployments, if you just looked at the pure costs on an apples-to-apples basis, the cloud deployment option is more expensive. Customers came to realize that, but accepted that due to the delivery model that doesn't require them to maintain, scale up, build out data centers to support big environments, as well as the innovation and continuous, stream of updates that is available with a cloud model that's more challenging to deliver through their own data center. So I think those were the trade-offs that they were willing to make previously. Again, as we're saying, that could change going into 2023, where really the bottom line cost is more important. And so if there's a cheaper option or a more economic option to deploy in their own data centers, potentially leverage private cloud, but do it with equipment they own and manage, that type of model could be more attractive this year than it was a year or 2 years ago.
Yeah, just to add to that, I think it's there. It means here today, in pockets, but it's going to get a lot worse, I think. If you think about everything that was discussed around solution bundling and layering. So, from purely the SaaS perspective, the best way it's been described to me by a client I work with is that think about Microsoft's licensing. It's a lot like going to college, where you have to do all these prerequisites before you can get the capstone class, which in the analogy is the capstone is that industry module. So in order to get that industry module, you have to have all these other licenses for various Dynamics, offerings, and then you can have whatever, the cloud for retail. So I think that, which is purely just the cost of the solution, creates a lot of sticker shock among customers looking to do, some of these more emerging sort of solutions. But then consider then all the layering of high compute capabilities that these companies are going to start to try to do across all these SaaS workloads, which is going to result in more sticker shock on that compute bill. Because if you're starting to add whatever AI, NLP, all these other value-add capabilities into something like a CRM, so that you can do call transcription and so on, your IaaS requirements are going to grow drastically. And then if you start to pursue some industrial IoT opportunities, where you're starting to look at thousands of data points a second off of a machine, and then that's all getting stored in a public cloud environment potentially, then the bills are just going to grow exponentially, and that's when we're going to see more resistance, so to speak, especially given how important cost is given the current macro climate.
Okay, great. Well, those are all the questions that we have. We're just about up on time, so thanks everybody for attending. I'll hand it over to Haley to wrap it up for us.
Thanks, Allan, and thank you all for attending today. Please feel free to reach out to the team with any follow-up questions. Their emails are up on the slides. If you have a few moments, it would be super appreciated if you could fill out the survey that's going to pop up on your screen. The replay version of today's webcast will be available after the event and will be sent out to all of you via email. To view a list of our upcoming and past webinars, please visit tbri.com. And be sure to join us next Thursday, January 19th, for Transparency, Consistency, Quality, Winning Formulas for IT Services, Digital Transformation, and Consulting in 2023, the continuation of our TBR webinar series, 2023 Predictions. Thank you all, and have a great rest of your day.